While the average investor was busy chasing the latest meme stocks, a select group of financial wizards, the super investors, were quietly amassing fortunes in companies you might not expect. And today we are pulling back the curtain on their latest picks. Now you might be wondering, Felix, how on earth did you get this information? Well, let's just say my golden retriever Winston has quite the nose for sniffing out financial data. It's a very large nose. But jokes aside, we've done the legwork. We've combed through mountains of SEC filings, market data to bring you the juiciest insights. And trust me, what we found is going to be very, very juicy indeed. So in the next few minutes, we'll dive deep into 3 companies that have caught the eye of investing legends like Warren Buffett and Daniel Loeb. We're talking about a ride-hailing giant that's more than just taxis, a financial powerhouse you've probably never heard of, and an energy company that's got even the Oracle of Omaha excited. Now, this isn't just about following the big players, it's about understanding why these companies are attracting attention and what it could mean for your portfolio. But speaking of portfolio, do you know that ours is up 93% already this year? That's a trading portfolio. If you want to know how we do it, well, I'm hosting a beginner trading training this coming Tuesday, and I'll teach you exactly what we use to set these up. Our rule book, essentially. It's a 3-step process. You can apply it in a couple of hours a week. So come and join us. The link's down below in the description. Secure your free spot and be part of the million people we aim to make financially free here in this community. Now, let's set the stage here with a quick look at the economic landscape. After all, even the brightest minds in finance don't make decisions in a vacuum. In September, we've witnessed a big shift in the US economy. The Fed, in a move that got everybody talking, slashed interest rates by 50 basis points. It's the first cut since the pandemic, and it's sending ripples through every corner of the market. So why is it such a big deal? Well, it's all about balance. The Fed's trying to thread the needle between taming inflation and keeping the job market from jumping off a cliff. On the inflation front, things are looking up. The Fed's projecting inflation to cool down to about 2.3% by year end, and they're patting themselves on the back saying, well done, we did it. But it gets a bit more interesting or complicated than that. The unemployment rate has ticked up to 4.4%. Now, that's not doom and gloom, but the job market is surely softening. And when the Fed dropped this rate cut bombshell, the market went a bit bonkers. The Dow Jones did its best impression of a roller coaster, up 375 points before everybody caught their breath. And guess what? There are likely more rate cuts on the horizon. So what does it mean for the super investors? Well, it's creating an interesting playground for them. With interest rates dropping, companies that rely heavily on borrowing might suddenly look a lot more attractive. With the job market cooling, firms that can navigate a tighter labor market could be the ones to watch. So our super investors are seeing opportunities where others see chaos. Let's look at our first company here. A company that's been riding the waves of the gig economy. And it's, of course, Uber Technologies. Founded in 2009 in San Francisco, Uber started with a simple idea. What if you could request a ride with just the tap of a button? Fast forward to 2024, and it's become a giant in the gig economy, operating in 70 countries, 10,500 cities worldwide. Uber is not just about getting to you from A to B anymore. They've diversified into 3 main segments. Mobility, that's your classic ride-sharing thingy. Delivery, which is fancy takeaway. And freight, which is moving goods, not just people. So with over 150 million active users, they are the largest ride-sharing company globally. And they're not stopping there. They've even dipped their toes into alcohol delivery with the acquisition of Drizzly, for example. Now, let's talk numbers. Uber's stock is currently trading around $74 as I'm recording this, and it's been on quite a ride this year. They're up a whopping 26%, but it hasn't been all smooth sailing. There was a bit of a wobble in August, but they managed to navigate through it. So why are some of the brightest minds in investing piling into Uber? Didn't we hear the rumor that Tesla was going to kill off Uber with their robo-taxi? Well, take Daniel Loeb of Third Point, for instance. This chap has increased his position by a staggering 320%. He now owns 2.1 million shares of Uber, pretty significant. It's the kind of conviction that makes you sit up and take notice. And then we have John Armitage of Egerton Capital and William von Müffling of Cantillon Capital Management. I didn't make these names up. No, they're real big investors. And they're both very savvy investors. And they made new buys. They picked up 1.7 million and 2.4 million shares each. And we can't forget David Tepper of Appaloosa Management, who increased his position by 10%, now holding 1.5 million shares. And what about Robert Carr of Joho Capital? Uber makes up a whopping 12% of his portfolio. And you might not be familiar with all of these investors, and that's okay. The world of hedge funds and funds is a weird one. You don't need to know these guys just to know that they are at the top of their game. Now imagine a world where your Uber arrives without a driver. That world is closer than you might think. And let's not forget about the experiments with drone deliveries, very much like what Amazon has done. Your future takeaway might be flown to your doorstep or your balcony if you live in a condo. But perhaps the most compelling reason for the super investors' interest in Uber is its dominant position in the gig economy. As traditional employment models continue to evolve, Uber's platform offers flexibility for workers and convenience for consumers. Now, it does seem that they take a rather outsized cut off the pie, but that's the dominant position. But there is more. For a company that's been burning through cash faster than a teenager with their first credit card, they are profitable. And it looks like they're going to continue to stay profitable. They also have pretty outstanding free cash flow. Now, of course, investing isn't without risks. There are regulatory challenges and competitors are nipping at Uber's heels. The Tesla robo-taxi, for example, or Uber's robo-taxis. But I guess once you have a position that is so dominant, where everybody in the world has Uber installed on their phone like I do, that is tremendous value. And building that up is incredibly expensive. So say even Tesla comes out with its robo-taxis. Well, why wouldn't Tesla sell 1 million of those robo-taxis to Uber? At which point, Uber doesn't need drivers anymore, so they get to keep all the money. They get to become more competitive. And all you need then is a little robot on the passenger seat or in the boot to deliver your groceries. And suddenly you have doubled or tripled the margins of an existing profitable, massive and fast-growing business. I think that's kind of the appeal. I think they just think, yes, Uber didn't deliver autonomous driving themselves. They never invested in that. But they just thought that isn't really our forte. We're going to rely on others to solve that problem, and then we're just going to rent it. And that might be a good thing to do. Just focus on what you're really good at, and that is an app and getting people to use it. But now let's turn our attention to a company that's less of a household name. But trust me, it is the backbone of many investment decisions you've likely made without even realizing it. I'm talking about MSCI Inc. It's founded in 1998, based in New York. MSCI has become the silent puppet master of the financial world. Imagine them as the behind-the-scenes director of a West End play or a Broadway play, depending on where you are based. And you don't see them, but their influence is felt everywhere. MSCI operates 4 main segments: index, analytics, ESG, I know. Actually, it's ESG and climate, oh God, and private assets. They're the chaps behind major indices like the MSCI World and the MSCI Emerging Markets Index. If you have ever invested in an international fund, chances are you've indirectly used MSCI services. They serve over 7,900 clients in more than 90 countries. We're talking about the creme de la creme of the investment world: pension funds, hedge funds, asset managers, cockroaches, you name it. MSCI's tools are the Swiss Army knife for these institutions, helping them with everything from risk management to portfolio construction. But let's look at their numbers. It's trading at around $550 as I'm recording this. They are down about a percentage point this year. Not exactly extraordinary, but don't let that fool you. Some of the sharpest minds in the investing world have been gobbling up MSCI shares like they're the latest crumpets at afternoon tea. Now I've got hungry. Let's start with David M. Poland of Poland Capital Management. This chap has increased his position by a mind-boggling 1,100%. He now owns 1.6 million shares. That's a little bit more than dipping your toes into it. And then we have Daniel Loeb again of Third Point. We've got Stuart McLaughlin of Triple Front Partners. Both made new buys, picking up 150,000 and 58,000 shares each. Then we have Nikolai Tangen of AKO Capital. He's holding onto a substantial position, making up 3% of its portfolio. So what have all these investment heavyweights got so excited about MSCI? Well, data. In today's world, data is the new oil, and MSCI is sitting on all the data. In the ever more popular need for ever growing sophisticated data analytics, in a world where information is everywhere, the ability to make sense of it is priceless, as MasterCard would say. And MSCI's tools help investors navigate this data morass like a seasoned captain steering through a storm. And there are whispers that MSCI might be expanding into new areas of fintech. Imagining combining their data knowledge with blockchain or AI, it could be a game changer. So these super investors seem to think that MSCI has the secret sauce to stay ahead of the pack, and perhaps it has another ace up its sleeve. Now, third and last, let's turn our attention to a company that's got Warren Buffett positively giddy. I'm talking about Occidental Petroleum, or Oxy, ticker symbol XOY. Founded in 1920 and headquartered in, of course, Houston, Texas, where every good oil major starts, they've been a stalwart of the American oil sector for over a century. Oxy operates three main segments: oil and gas, chemical, and midstream and marketing. They're not just about pumping oil out of the ground. They're involved in everything from exploration to petrochemical manufacturing. So they kind of do a bit of everything in that industry. And their operations, they're in the US, the Middle East, North Africa. So they're global. They're ranked in the first 150 on the Fortune 500. Not too shabby. So let's look at their numbers. Oxy stock is currently trading around $51. I'm afraid it's not all sunshine. They're down about 14% year to date from their April highs of $17. Bumpy ride, but some of the brightest minds in investments have been snapping up Oxy shares like they're the last tickets to, whatever it is that you like to watch. Warren, of course, we call him Warren, through Berkshire Hathaway, is holding on to 255 million shares worth over $16 billion. That is 5.75% of Berkshire's portfolio. That's pretty big. Then we have Li Lu of Himalaya Capital Management, and he made a buy of nearly 1.5 million shares. He's an old pal of Charlie Munger, of course. So coming from a value investor known for his connections to the very same Charlie Munger, may he rest in peace, it's, sort of another royal seal of approval, really, isn't it? Then we have Ravenel Boykin Curry of Eagle Capital Management. He's increased his position by 6%, now holding 11 million shares. We've got Duan Yongping of H&H, who increased his stake by 36%, and they're all very excited about this. But why? Well, Oxy has very low production costs on oil. And in a world where everyone's talking about carbon neutrality and windmills and all that sort of stuff, while Microsoft is switching the nuclear power plants back on, as long as you realize that the energy need of the US is exploding because of data centers, no one's going to phase out oil or gas at any point in the next decade or two, because there is an energy shortage coming our way. And I think that's probably all we need to know, that energy is going to be in short supply, and therefore the sector is going to see quite a lot of investment. And in addition to that, because oil and gas has been seen as this dirty, horrible, carbon-producing nightmare that we must extinguish as quickly as possible so that Bill Gates can turn the nuclear power stations back on, because they never pollute anywhere, ever, right? Clean as a whistle. But what that's, of course, caused is a massive underinvestment in new oil and gas exploration, because it's just not been the thing to do. As Tallulah whispered to me, being a contrarian is often the best thing to do. Much like we want to be one of the last shareholders of Philip Morris, as the last smoker dies somewhere sadly, the money is still in that industry. And I think the same is true for oil and gas. So of course, I'm not telling you to go buy the stock, but I think it's definitely worth digging around in. So let's connect the dots and see what these super investors' picks tell us about the broader market, so we actually learn something from this. First off, what do a ride-hailing app, a financial data provider, and an oil company have in common? Not much, right? But if you dig a little deeper, we start to see there are some patterns here. Let's start with the revenue. For the first half of 2024, MSCI reported a very robust 1.4 billion in revenue. Occidental Petroleum brought in almost 13 billion, and Uber topped the chart with a whopping 21 billion. Now, here is where it gets a little bit more interesting. MSCI saw a 14% year-over-year growth. Occidental saw a decrease of 8%, energy sector challenges, but Uber, well, remarkable growth there with 15%. But let's look at profitability. Maybe that's where the pattern is. MSCI, it's got pretty decent performance there. Net income was 500 million. Occidental, despite the revenue dip, still created a $2 billion profit. And Uber managed to bring in an extra 360 billion in net income. And beyond the buys, I also looked at, are any super investors selling these companies? And you find hardly any. And it tells you something. There is a dedication here. These guys are settling in for the long haul, and the gains might not be immediately obvious from the financials, but they're looking beyond the next quarter or even the next year. They might even be thinking in decades. Of course, even the brightest minds in investing can make mistakes, so past performance doesn't guarantee future results. The best thing usually is to do is to ask a cat. They're much smarter than people, I found. And do your own research. So if you found some value in this video and you want to learn from Tallulah how she is up 93% so far this year, then come and join us on Tuesday for a live trading session where I will teach beginners how we do what we do. I'll teach you our rules and how you could apply them yourself in just a couple of hours a week. And I thank you for watching. I thank you for tuning in, and I hope to see you on the next one. Today, we're diving into a story that could potentially turn Palantir stock into a $100 plus powerhouse. Yeah, you heard that right, $100 per share. Now, I know that sounds as bold as Winston's attempts to catch a squirrel.